We've certainly had our fair share of market volatility to start this year. Many are projecting that it will continue for the rest of this year. How do you invest during volatile times? I've got 3 ideas for you coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So, all right, I don't know when you're consuming this content, but I'm recording it early March of 2022, and yeah, it's been a volatile ride, right? January, up until the final 2 days of the month, was on track to be the worst January since the Great Depression. Now, the final 2 trading days, things came back. February was awful as well, and right up until the market convinced itself that the Fed wasn't going to raise rates as often as they previously hoped in light of the Russia-Ukraine crisis, February was atrocious as well. Certainly still negative month and challenging. Lots of volatility to start this year, and it's got many investors saying, how do I invest through volatility? You know, the old strategy of just of a stock bond mix, does that even work anymore? How do you invest during a volatile time? I've got 3 ideas for you. The first idea is maybe consider something called a low volatility mutual fund or exchange traded fund. So a low vol fund or minimum volatility, okay? There are specialty mutual funds that I'm not recommending, okay? You're gonna have to work with your CFP to see how this would fit in your overall portfolio, but there are certain investments where the strategy is not to go up as much when the market's going up and therefore not to go down as much when the market's going down, but be more low volatility, more market neutral. Those are 2 different categories that you can consider. Oftentimes low volatility might be mixed with high dividend, low vol, something like that. So there are specialty mutual funds, specialty exchange traded funds that you might want to consider. Again, not recommending, work with your CFP on that. The big point that I would make though is it's not going to go up as much when the market goes up. So if this whole thing blows over and we've overestimated the amount of interest rate hikes that the Fed's going to do, and the Russia-Ukraine thing actually gets smoothed out in some unbelievable way, and we see a tremendous upside, you're going to miss out on a chunk of that. But the hope would be, the trade-off would be that you don't experience as much downside or much volatility along the way. You can lose money in these investments, okay? And past performance is no guarantee of future results, right? So you know that. That disclosure, but with these low volatility funds and strategies, these unique ETFs and mutual funds, you can still lose money, but they're designed so that the ride along the way isn't as bumpy. Work with your CFP on that. And second, yeah, I mentioned it before, but you can still just stick with diversification, okay? A mix of large, small, and medium U.S. international stocks, as well as diversifying with bonds. Most people have kind of thrown bonds out with the bathwater because, well, interest rates are going up. Bond investments don't do well during that environment. So therefore, there's not much opportunity to make money in bonds. So I'm going to allocate more to stocks. That is a method of increasing volatility, okay? And if you don't have the stomach for that, then still making sure that you're properly diversified between stocks and bonds. Because as I've said before, and I'll say it time and again, a bad year in the bond market is a bad day or even a bad afternoon in stocks, okay? So they have definitely different experiences with risk. And so a diversified allocation between stocks and bonds can help lower your overall volatility. Additionally, based on how the past 10 years have gone, many people have said, nah, I'm just sticking with US stocks or large cap stocks, something like that. Making sure that your stocks are diversified so that you're not just overloaded in one area like NASDAQ or like US stocks, and making sure that you're broadly diversified, that can help you manage volatility, manage that risk as well. And then the final idea that I would throw at you for managing today's volatility and investing through it is something that we're doing a lot of here at KFG, and that is working with exchange traded funds that have a hedged type of approach to them, meaning similar to that low volatility strategy, but it's specific in that, all right, I'm investing in the S&P 500 or I'm investing in a certain index where over the next year, I will participate in X amount of the upside if the market's up, and I will protect myself against X% of the downside if the market's down, okay? So those are defined outcome or target outcome exchange traded funds. They're also called buffer strategies. We call them hedge strategies here. You're participating in a certain amount of the upside up to a cap, and then you're protecting yourself and avoiding the first X amount of the downside. They come in different flavors, and they're not for everyone, and you certainly can lose money. I would also tell you that even though those are defined outcome based on a certain future date, they are trading every single day, and so they can move very differently than what that defined outcome is all along the way. You're going to want to make sure you understand that, which is why I would tell you, if you're trying to invest managing volatility during this tricky time, you've got to work with your CFP. These are 3 different ideas, but work with your CFP. See if any of them make sense for you, because I would argue, number 1, you've got to make sure that you've got a prudent investment strategy for your unique situation connected to your financial plan, connected to your risk tolerance, okay? That's number 1. Second, make sure you're sticking with that strategy during good times and bad. Your investment strategy that's for the long-term investor isn't one that should just be used during, well, you know, everything's going up, so let's do this. Well, now everything's going down, so let's do this. It should be a strategy that, doesn't avoid volatility, which that would be ideal. If so, you're avoiding volatility both on the downside and upside. And most people are investing to have some sort of long-term gain, long-term appreciation. So work with your CFP, make sure you've got that prudent strategy, and make sure you're taking the right level of risk for your situation. If you don't have a CFP on your team, you can always contact one on my team. Find us online, korhorn.com, that's Korhorn with the K. wisemoneyshow.com, you can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.